Was it Ebola, Oscar Pistorius, the Middle East, or the IMF that triggered the recent sell-off and the huge volatility that we've seen on global markets that rubbed off so much on the JSE? This is Tonight. I'm Bruce Whitfield. These are volatile markets and answers are hard to come by. But one thing for sure is that somebody is making money, be it those shorting the market and finally getting some money for doing that, or the JSE, which experienced record trades. Tonight, I'm joined by Gary Booysens, Head of Trading at Vunani Private Clients, and Andrew Kinsey, the Chief Risk Officer at GT247.com, to find out how you can also make some money from volatility. You guys, Andrew, you love volatility. Volatility is like mother's milk to a newborn baby in the trading environment, surely.
Stand accused and admit freely. Absolutely.
Absolutely.
Yeah.
How much pandemonium was there?
It was a vigorous sell-off, but as far as I was concerned, it was an orderly market. I mean, it moved pretty quickly, but there was no capitulation that I saw. Perhaps a little bit on Thursday, but no capitulation. So we may have some way to go.
I might need a translation on this, please, Gary Booysens. So what is the difference between an orderly sell-off, capitulation, and a collapse? Because it felt like the latter two at various points.
I think it's very blurred lines and how you define them. Each person has their own definition. I mean, I spoke to a lot of clients that felt like it was capitulation for them, and I think a lot of it comes down to a personal thing. But I think when Andrew's talking about an orderly market as well, I mean, we didn't see any trading halts. I mean, if you think of a disorderly sell-off, that was the implosion of Ebola. I mean, the thing couldn't stay outside the circuit breakers for 30 seconds without getting chucked into a volatility auction. Now that's definitely disorderly. There was no trading halts, anything like that. It was sustained selling over what, it was about 3 weeks that took. Where I hope we got to the bottom.
we did for now, which is always encouraging, isn't it? We're 10% below the record levels that we saw in the last 6 months. But the JSE under a bit of pressure. Nice buying opportunity for you, Gary, or is there more to come? One can't help but feel the market's a little bit tentative and a bit pensive.
I think whenever you get a turn, I mean, the volatility always increases the most at the bottom as its maximum uncertainty. I mean, you have to go look at the lows of sort of 2008, 2009, and you can just see the volatility absolutely off the charts.
Because the VIX index, which measures volatility or fear in the market, hit 30, whatever that means, but it's the highest level in the last 3 years, then came back to about 22 at the start of this week, which is kind of high for the last 2 years, but not crazy. And that's the sort of sense of it. So people are prickly, but not frightened.
Yeah. If you look at something like the VIX, I mean, obviously we did see that VIX spike. I mean, traditionally over the last it's almost four or 5 years now, I mean, you've seen the VIX trading a range between sort of 12 and 18, no problem. This is the first spike we've had outside it in a long time, and I think that's really what got investors to panic and start going and looking for a little bit of maybe option protection, or starting to hedge portfolios and doing all the wonderful things you can do to protect yourself if this is a sustained 30-40% correction. But looking at the VIX, I mean, that's how the it's the Chicago Board Options Exchange, how they price 30-day forward, at least implied volatility. So it gives you a measure of how the market's feeling. It's giving you a measure of how many options are being traded as well. So there is a supply and demand of the vols in the US on the S&P 500. So it gives you a sense of how investors are feeling, and lately definitely not feeling very good.
No, absolutely, the volatility has been quite extraordinary, but you make money out of it. Andrew admitted it. He said volatility is mother's milk. I said it's mother's milk. He agreed.
No question. You make money out of it, but there's different ways of making money out of volatility. And I think when they're talking about trading firms making money out of volatility, you look at the company. I mean, because investors are panicking, a lot of shares are changing hands.
It's about volumes and it's about commissions on trades.
Exactly. It's the smart money trying to get in at better levels. It's the weekends being shaken out, which really ups trade volume. I mean, you look at the head of at least there was the head of Morgan Stanley saying, that it was Morgan Stanley, Goldman Sachs saying the trade volumes this year have been so incredibly low. This is absolute abnormal situation. I mean, everyone back then was blaming the Fed, saying these QE programs it's killed vols in the market.
But those QE programs are so interesting. So a guy called James Bullard, who until Thursday last week nobody outside the Bullard family had heard of, suddenly becomes the most famous guy in markets in the world, because he has the audacity to stick up his hand and say, you know what, maybe this QE thing, it's been too quick to remove it. And suddenly we saw this extraordinary turnaround in the JSE from 1,000 points down to 300 points up in a single day, and then things calmed down again. This is one oak who doesn't have the final say, suggesting that it may be a possibility. I mean, that's shows that markets are bonkers.
Well, it shows that they're like heroin addicts. They're just they have this fix on easy money. And somebody like James Bullard from the St. Louis Fed says, well, maybe we should have QE4. People turn around and say, well, let's put out a Fed funds increase for another 3 to 6 months. You can argue about whether that'll actually be a beneficial program, because the essence is that they want to keep long-term rates low.
Yes.
But the problem with that is that long-term rates are already low. And as Gary said, it's killed volatility. And the problem with killing volatility, as they've done, is that everybody becomes complacent. Over a period of years, your risk positions.
The complacency then breeds the sort of knee-jerk reaction we saw in the last week or so.
Yeah.
So we'll go through another period of 3 to 6 months of complacency. We'll then have another mad panic, probably.
Well, it's arguable whether that sort of volatility is here to stay. And I read an article over the weekend by Gillian Tett from the Financial Times, and she said two things. Is that everybody is now positioned in exactly the same way. The Fed have done, and the ECB and the Bank of Japan have made sure that investors are all aligned in their positioning. And the only thing that they can do now is go out on the risk spectrum. So they look for higher and higher beta shares. They look for high yielding opportunities. The other thing she said was that because of the Volcker rule, and the regulators clamping down on the amount of risk assets that the broker-dealers can hold, bonds and equities, is that structurally there is less liquidity than there has been for a decade.
What is the consequence then for Joe Schmo like me, sitting on the sidelines and watching this going, markets are crazy, I can't dare, I'm going to put my money under a mattress into a post office account, if there was ever a post office open to put it into the account, or I'll go put it into some sort of fixed interest vehicle at 6 or 7%, because that's what happens to ordinary people at times like this. They get dissuaded from markets, and that's one of the great tragedies of this kind of volatility, Gary.
No, definitely. I mean, you look at it, and I mean, you can compare, a cash return and the JSE. I think we briefly ticked negative for the year. And I think, investors forget that, over the long term, if you can hold for 5-10 years, the market is one of the best wealth creating tools that you have at your disposal. And for retail investors, it's easier than ever to enter. So it is, like you say, very, very sad. But the smarter money and perhaps the more sophisticated investors, or maybe even just the lucky investors, are using
Mostly it's the lucky investors.
Using this as a great opportunity, I think, to enter. I mean, you've looked at a market that really just hasn't had many pullbacks, and I mean, guys are always, the saying is buy the dip. I'll leave the F out.
Yeah.
But and that market has been very difficult this year because you just haven't had an opportunity to enter. And I think it's giving retail investors definitely a brilliant.
Is this the end of momentum trading? And is it the beginning of a new phase of the market?
Well, it may be the end of blind momentum.
Blind, right? I didn't know that we divided momentum.
Listen, I nuance every statement that I say, but I think the point to make that Gary has touched on is that if you have been putting a small amount of money into the market over the last 3 to 4 years, this pullback is absolutely nothing to be concerned.
It's manna from heaven. Yeah.
I think the problem where the panic comes in is that because we haven't had a pullback for so long, that once we get it, we have people buying the dip at 3% down, 5% down, and then suddenly we're down 10.
And they start selling at 10 because now they're panicking.
They sell it at 10 because they've only positioned themselves in the last 6 weeks. And it's those people who, as Gary mentioned, are the weak hands. Whereas if you've been a solid investor, this sort of thing is absolutely nothing to get concerned about.
And that's ultimately the point to make with this, Gary, because it is about adding value over time. But we also have this strange coincidence that the big sell-off happened in the week of the 1987 crash. I mean, the 1987 crash. And I saw a stat yesterday which suggested that if we saw the same 22.7% pullback on the Dow as we saw in 1987 on the October the 20th or 21st, it would be a 3,500 point reduction in the value of the Dow, which is indescribable in our context. This stuff happens. Why will it not happen this time, Gary Booysen?
Yeah, who can say it's not going to happen? Maybe this is a small dead cat bounce.
Commit.
No, but I personally, I don't think it is. I mean,
because there's Fed support.
I think there is Fed support. I still think that you can play the old Bernanke put. You can now play the Yellen put. I think, and now it's sort of turning into the Draghi put as well, because really, I mean, these central banks are standing ready to do whatever is necessary. And I mean, I think we sort of forgot that with the wrapping up of the QE program now, and they're moving away. Like you said, Bullard obviously coming back. But I mean, we've got to remember that the Eurozone now is poised for a stimulus package, a proper stimulus package for the first time, really since the crisis. Because finally Germany, with also the Russian sanctions that have happened, the industrial sort of numbers are coming in very, very poor.
So, but Germany's struggling. China is slowing. America, people are buying the turnaround completely.
Okay, but we'll talk about the US in a second. But the fact with the Germans is suddenly with them not quite in the same position as they were, they sort of are a little bit more aligned to the periphery. So maybe we'll see some sort of unified policy coming out of the Eurozone, which I think is a very good thing. But of the US, I mean, what are we talking here? Yes, their recovery may be slowing, a few bad data points. I mean, their labour market at sort of, they almost reaching record unemployment. I know you're going to say to me, no, but there's all the people that don't want to work anymore. But even that, I mean, on that stat, you're looking at probably, I think it was 12.8 down to about 11.9% unemployment rate, which is still very good. We've got no inflation, so why shouldn't the Fed? Why will the Fed be raising interest rates if there's no inflation?
Ultimately, this has got to be good for macro South Africa. We've already seen a little bit of rand strength as a result. See the oil prices coming off. That's got to be good for inflation. It plays quite nicely into a South African macro environment. What it does for share prices, goodness knows. But from a macro perspective, it gives us. It feels like we're headed for a bit of a breather come 2015.
We could. I mean, there's certainly a lot of issues that we need to resolve. There certainly has been over the last sort of 18 months a growing sense of, I wouldn't say panic but where are we going? We
Despair, I think, is the word you're looking for. Yes,
possibly. We seem a little rudderless from a political perspective. Yeah. There seems to be a perception growing that Jacob Zuma is a little more under pressure than he used to be.
This is a whole conversation for another day.
No, absolutely.
But I'm forecasting 2015 better than 2014. Yes or no?
No.
No.
In terms of markets or economy?
Both.
Markets better, economy worse.
Oh my goodness me! Okay. I'll be the perma bull on this particular show. Gary Booysens, he's Papa Bear this evening, head of trading at Vunani Private Clients, closely supported by Andrew Kinsey, chief risk officer at GT247.com. Thank you for watching. There'll be more volatility tomorrow. Until then, be explosive. Good night.